Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The reality of today's market is that a handful of companies, the mega cap stocks, are so large that it's difficult to build a strategy that both beats its benchmark and avoids overconcentration. Depending on advisors' views on portfolio construction and diversification, this is either a huge risk or a major opportunity. Joining me to discuss the latest research from YCharts, the real impact of mega cap stocks on your portfolio and the market, is Kitko, Director of Product Marketing at YCharts. Connor, it is great to see you again. Welcome back to Trade Talks.
Thank you, Jill. I'm very excited to be here.
Give us a high-level overview of the research. What counts as a mega cap stock, and what types of portfolios did you sample?
Sure. So we called them mega cap stocks in our research, but everyone knows, FANG and FANG-M, a lot of the monikers out there. This small group of companies like Apple, Alphabet, Microsoft, Amazon, and Tesla, they've been huge winners over the last decade, but they've now grown so large that we know they dominate the S&P 500 and they drive a hefty portion of its gains and its volatility. But now it's created a little bit of a complicated situation in many investors' portfolios. So to conduct this research, we looked at a 60% equity, 40% bond portfolio, and we built this using some of the most common mutual funds for international stocks, domestic stocks, what have you. And then we tested some variations that included increasingly more exposure to these mega cap names, both individually and together.
How much exposure does a typical investor already have to mega cap stocks through mutual funds and ETFs?
Yeah, the key point is through mutual funds and ETFs, but we found that investors in a 60-40 portfolio, a pretty moderate allocation, actually have about 7.4% of their money invested in just these 8 mega cap companies. If you go up to an 80% equity, 20% bond allocation, that exposure rises to 10%. So definitely a material amount of the average investor portfolio.
How much wealth can be erased when one or more of these mega cap stocks crashes?
So for the individual investor, our research, we identified 3 instances going back to 2016 when a few or more of these names like Amazon, Tesla, and Meta, or formerly Facebook, all sold off in unison and relatively quickly. And a 60-40 portfolio would have lost 9 to 12% in each of these periods. So if we're talking about $1 million portfolio, that's $90,000 to $120,000 erased in a matter of months. For the companies themselves, looking the current year, the current drawdown we're seeing in 2022, these mega cap stocks have lost a combined $2.9 trillion of market capitalization, which is equal to or greater than GDPs of countries like Canada, Germany, and the UK. So a large amount of value for the market and for investors when these stocks go south together.
How would a portfolio's performance and risk be impacted by an additional position in any of the mega cap stocks?
Yeah, this is actually a little bit of a fun question, and the reason why we started this research. So many advisors we work with at YCharts have heard the question, should I buy more Apple? Should I buy Tesla? All the while knowing that the individual asking the question probably already owns these stocks via mutual funds or ETFs. But to answer the question still, we took our 60-40 portfolio and we added a 5% allocation to each of those mega cap names while maintaining that overall 60-40 balance. And we found that Microsoft, Amazon, and Apple, perhaps not surprisingly, have the best risk-adjusted returns. A 5% investment in any of them would have added 1.2 to 1.6 points of extra return over each of the last 5 years. And with those 3 names, the portfolio standard deviation was actually barely affected. However, within these mega caps, we looked at Tesla as well. Adding a 5% tilt to Tesla would have added 3.9 points of return every year, which is very awesome to see. But the portfolio standard deviation would have increased by 20%, probably not stomachable year in and year out for most investors.
Now, Connor, what if you had bet the house on mega cap stocks?
If someone really wanted to, we did look into this. We also created a portfolio, still 60% equity, but where all 60% was invested in an equal weight basket of these 8 companies. So you're walking away from the S&P and just betting on these big mega cap names. Going back to 2012, that would have more than tripled your performance in a 60-40 portfolio. But standard deviation for that portfolio was consistently double that of the baseline 60-40. So you're definitely turning up the dials on that risk reward relationship in your portfolio. And like you said, bet the house, you're putting a lot more chips into the middle of the table with a strategy like that.
How would the S&P 500 have performed without these mega cap names, and would its volatility profile change?
Yes, absolutely to the latter question. And this is the big conundrum that our research identified. These stocks are absolutely the reason for so much of the market's gains over the last decade. We looked at a hypothetical version of the S&P where these stocks did not exist. And then we looked at historical performance, and its annualized total return would have been reduced by more than half, from 15.2% to 7% over the last decade. And if you look only at Apple, if you took only that out of the S&P 500, the index's annual return would be reduced by 2 percentage points per year. In terms of risk and the volatility you mentioned, same story, but the opposite side of that story. By excluding the mega cap stocks, the S&P's annualized standard deviation was cut in half, or reduced by about 50%.
Yeah, interesting. So, Connor, the obvious question to wrap up here, how important is it to know what you own and which mutual funds and ETFs have the most concentrated positions in mega cap stocks?
We feel that it's extremely important. The modern professionally managed portfolios are built using mutual funds and ETFs for very good reason. There's a lot of benefits, but investors and whoever they're working with to manage their investments will be well served to look that layer deeper, understand what the individual securities in their portfolio are and what their exposure is, so that when a major event happens, like we're seeing right now to start 2022, and a ticker is making the news, they know, should I be happy? Should I be concerned? Should I pick up the phone and maybe take action? All of that potential hysteria could be avoided by knowing exactly what you're exposed to.
All right. Appreciate the insight, Connor. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.